Well, thanks for staying tuned to Bloomberg Quint and welcome to this very special coverage on RBI's monetary policy. The Monetary Policy Committee has been in a huddle for 2 days now and firmed up on the decision on rates by now as well. We will, of course, have to wait for 29 more minutes before the official announcement and then the RBI Governor's press conference that follows as well. Pradeep, the market's probably going into this policy, or not probably, going into this policy believing that it will be a status quo.
Definitely, but I think we'll have to look into the details in the sense that there could be some nuanced communication from RBI that may affect not so much equity market but debt market, because debt markets are actually extremely oversold with yields quoting around 7.1. So he or say the policy committee may try to send out some signals to the debt market. So that is one point which the market is really focusing on. I don't think there will be something significant enough to move the equity markets, but if debt markets do calm down due to whatever reason, that could send some relief waves to equity as well.
Unless they go ahead and do the unthinkable right now, which is cut their policy rates by 25 bits.
That would be very difficult because, last time around, if you look at it, 5 members voted in favor of a status quo. There was one dissenting voice, Professor Dhulakia, as he has always been a known dove in the committee.
Yeah.
And at the end of it, the discussion went to the dip in GVA and GDP growth in first quarter, and all the members believed that this was probably transitory and the Q2 number will be better, as it has been. So if you want a continuity in your policy approach, there is nothing to justify a cut now if you didn't take that opportunity last time around.
And keep in mind that it was not just the expectations for Q2, but the RBI stance on GDP growth in Q3 and Q4 as well has been fairly bullish. I think at that point of time, the commentary was that I distinctly remember Urjit Patel saying that they believe that Q3 and quarter 4 will have a fairly decent chance of the economic growth picking up as well. So aside of all that happens on the policy, I would personally be looking out for 2 things. One, whether they do revise and by how much do they revise the rates on GDP, the expectations GDP and inflation trajectory as well. Because we have to face the fact that while commodities may have dipped today, there's been a bit of an uptick in commodities. Vegetable prices have moved up. Oil is no longer the same beast that it was 3 months back or 2 months back. So we are hitting into a zone wherein global tightening will also happen. Inflation expectations might move up. So the RBI is setting the stage for GDP and inflation would be fairly important.
So last time around, they cut the GVA forecast to 6.7% from 7.3% that they projected in August. But we should also remember that the last policy was a half-yearly policy when a monetary policy report accompanied the monetary policy document, so to say. Now this time around, it's just a quarterly policy, not that significant. They may decide to wait. While last time there was a compulsion to review the forecast, this time there is no compulsion.
Compulsion to review the forecast.
If you want to send out a signal, or if you are reasonably convinced that your projection is incorrect on either side, then probably you will come out and revise those numbers. Otherwise, you'll probably not. You have the option of not really altering it and wait for 2 more months.
Yeah, well, we'll get to know in about 26 odd minutes. Let's first, though, before we get in our experts, and we have a battery of experts, quite frankly, on the show. But before we do that, let's go across to Ira Duggal, who's outside the RBI to find out what we can expect from the central bank this time around. Ira.
The Monetary Policy Committee will deliver the 5th verdict of the current financial year. The expectation and a near consensus expectation is that you will see no change in interest rates, which means the repo rate will stay at 6%, the reverse repo rate will stay at 5.75%. There is a small minority which still believes that there is some room for a rate cut, and the MPC may want to use that room before it closes completely. That constituency is arguing that growth is still weak, while we've seen a tentative recovery in the second quarter of the current financial year based on the GVA data. That recovery is still very tentative, and the output gap, the negative output gap, is fairly wide. So the RBI and the MPC should perhaps use the opportunity that it has to cut rates one more time. The debate behind the decision, even if you don't get a change, is going to be an interesting one, because we still want to see what the MPC makes of the growth numbers in particular. Remember, the 6.1% GVA growth was mostly in line with expectations, but the deconstruction constructed data had thrown out a fair number of conflicting indicators. One such indicator suggested that consumer spending, growth in consumer spending is slowing, so there may be some questions about that. On the other hand, you were seeing a slight improvement in the growth in gross fixed capital formation. So, conflicting indicators about whether investment is picking up, whether consumption growth is slowing down, and then also the impact of government finances and strained government finances on growth going ahead from here on. So far, the MPC has maintained that growth will be at 6.7% for the current year. They changed that forecast only in the last policy, so I would be surprised to see another roundward revision in growth forecast. But if that is there, then that is highly noteworthy. On the inflation front, we all know that headline inflation is below the RBI's target of 4% at about 3.6% right now. But the question is, where does it go from here on? Do you see higher fuel prices, higher metal prices start to feed into the inflation number? And then going into next year, what are the implications of fiscal slippage on inflation as well? All of those questions up for debate in front of the MPC. What you may not get from the MPC, but what the market is watching very closely for in the commentary that follows, is what is the RBI's thinking on liquidity. Bond yields have moved up by 40 basis points between October and now. They're above 7%. Is the RBI comfortable with that? If not, do they throw in some language that suggests that they will not return to open market operation bond sales, or a commitment to maintaining comfortable liquidity conditions? That's what the bond market is watching for very, very closely.
Well, thanks, Ira. Bond market is closely watching the details or the fine prints of this RBI Monetary Policy Committee statement that will come out. Upasna Bharadwaj of Kotak Mahindra Bank is joining us. Also, Ajay Bagga of OPC Asset Solutions and R. Sivakumar of Axis Mutual Funds are also joining us on the show. Mr. Bagga, what do you think? In terms of takeaways for equity market, do you really think, the correction that we have seen over last few sessions can be reversed dramatically after the RBI policy statement?
I think it's more of a non-event, as far as the Indian markets go. It's more the global issues which are seeing a correction in our markets. It's more coming from a global correction in the equities. As far as this policy goes, the focus will largely be on what is the growth projections for the next 2 quarters, and what are the inflation expectations that the RBI is laying out. What does it talk about the NPA scenario? Does it see that NPAs have more or less now stabilized, and they should start running off over the next 4 to 8 quarters? Any news on the bankruptcy proceedings? How are they viewing the IBC proceedings? The bank recapitalization, any more clarity on that? I think these will be a few of the things that the market will be looking at. The yields have gone higher, much higher than 7%. That has been an overreaction, so there could be some amount of reaction post the event going through, and you could see a little bit of softness in yields if the policy doesn't come through very hawkish. I think those are a few of the things that the market will be looking at, but impact on equity markets largely baked in, and more the global events shaping the contours of the Indian equity markets right now.
So far as details on the bankruptcy process and all is concerned, I don't think that would be a focus of the Monetary Policy Committee discussions, but I'm sure the journalists will be asking some pertinent questions in the press conference, and whatever governor says about it would really be important. But the bond yield, an issue that Ira was also mentioning. Upasna, what do you think? Bond markets looks like have kind of factored in a very hawkish policy, and if the policy statement doesn't turn out to be that hawkish, or rather, do you think the Monetary Policy Committee would like to address the concerns of bond market in one way or the other?
No, I think just going a little bit one step back, bond markets have been reacting to a couple of things. in the last 2 months or so. First and foremost, I think the biggest issue which the bond markets are facing is the risk of a fiscal slippage. And I think that excess, the fear of excess supply is something which is really overburdening the markets. And that is one of the reasons why bond yields continue to surge higher and higher. Now, along with that, of course, in the last 2 months or so, we've seen a significant up move in oil prices. So commodities are definitely not helping either. And to add to that, of course, now that we have a monetary policy decision, and just ahead of that, we had the growth numbers, which did show a cyclical recovery. So all in all, it looks like that RBI should be pointing towards at least as much as hawkish as it was in the previous policy, even if it's very difficult to believe that they would be able to sound very balanced. At this point in time, with the fiscal risks domestically, with the inflation moving upward, definitely in the subsequent reading that we're going to get, the reading looks a tad above 4%, and then the subsequent all readings look higher than 4%, which is their medium-term target. So I think fiscal risks, inflation up move, commodity prices higher. Globally, the US Treasury yields are also inching higher, given that the Fed rate hikes are kind of getting priced in more and more going into the next year. So I think the situation looks very difficult at this point in time for RBI to sound dovish or balanced. At best, they can maintain is a hawkish stance, which was already witnessed in the previous policy. To that extent, I think incrementally higher oil prices and commodity prices are going to just add on to the hawkishness. Having said that, I think bond markets are already going into the policy with these expectations. And yes, if by any chance RBI was to sound a little more balanced, then we may see a brief relief rally, but that's going to be very, very brief and not a significant rally, so to say, because the real concern is the supply concerns, and that does not really go away with the policy statement. So I think at this point in time, it is more the supply concerns which is concerning or which is bothering the markets, and hence I do not see a meaningful correction from these levels.
Okay, R. Sivakumar also with us, as is Rajeev Ahuja, Executive Director of RBL Bank. Shiva, let me start with you first. What do you expect to hear from the RBI on the liquidity front? Because arguably, if you look at how tight the liquidity situation is currently, all that was demonetized has been remonetized. There was a view in the morning that came in that with increased borrowing that could happen in the Jan, Feb, March quarter as well. Their commentary on this subject, and they're setting the stage for the next quarter as also calendar year 18 becomes extremely important.
Oh, I completely agree, and I think liquidity has been one of the factors which is which we have not addressed so far, which has driven bond yields higher. So if you look at the short-term interest rates, for example, the one-year overnight index swap, which is a good benchmark for short-term expectations of monetary policy, it has swung up by about 60 basis points over the course of the last 12 months. And during this period, the only thing that RBI has done is cut rates by 25. So what that suggests is that the market has gone from expecting a lot of RBI rate cuts to a combination of tighter liquidity and potentially even a rate hike over the next 12 months. So it does suggest that the RBI's policy on liquidity is just dovetailing into this whole expectations of more hawkish stance going forward. And now, of course, seasonally also this is a tight liquidity period, second half of the year, and therefore we do expect some kind of tightness to continue in the next few months.
Keep in mind the equity markets too, not really factoring in the policy today. I think what the equity markets are doing today is more a factor of what's happening across the world. We've seen what Hang Seng has gone through. The Asian markets have not been a pretty place to sit at in today's session. The other world markets, the developed markets at least seem to be okay. But today's move on the equity markets at least doesn't seem to be a factor of the policy. As I think Ajay Bagga was saying, probably the policy doesn't have the wherewithal to really change or alter the course. It probably has to do with the elections. But we have a bank amidst us as well, as I said. Rajeev Ahuja, ED of RBL Bank, joins us on the show again. Good having you, Mr. Ahuja. Thanks so much for taking the time out. What would your thoughts be?
I think I'll just echo what I've just heard. I think at best it will be neutral. From a tone perspective.
From a tone perspective.
I think the clear highlights of last time were they're watching inflation, they're watching the fisc, they're watching GST transition. Recap was something they had mentioned by capitalization of PSU banks. Some of those things are going through the system, and I think they're going through well. But I think inflation growth re-emerging, and global monetary policy, which looks like increases all over. So I don't think RBI has any other way except to stay. At best, we won't do anything with the rates, but our tone will become perhaps a little more conservative.
So that is actually the macro perspective. But if you look at the other side of it, as a banker, you will have an idea as to how optimistic your borrowers really are, and they're definitely not optimistic at this point of time. Don't you think when in last policy RBI cut down the projection on GDP growth, they actually need to still keep an eye on growth and not talk too hawkish, keep an option open that where they can come out and support the economy with a rate cut still?
Yeah, I think, look, first of all, RBI's job is to manage many macro fundamentals. And as I mentioned on your program last time, I think the victory over inflation, breaking the back of inflation over the last few years is so important from a long-term perspective of productivity and equitizing the pain across the economy, because the inflation impacts different segments differently. I don't think RBI should sacrifice it, even if it means a short-term benefit for govy traders or some borrowers. I think what we need to ensure is the fundamental construct of inflation being moderate, improving the banking and the monetary transmission system. And I think on margin things will keep getting better in terms of utilization. I think we'll always look back and say, oh, it actually happened 9-10 months earlier, and these are not things which you will see on a day-to-day basis. Clearly, many segments are still feeling challenged, but I think if you see some of the stuff around GST changes, the recap, and a natural utilization of capacities in most segments, I think you look back and say, like, actually, if those things were to, on a micro segment perspective, start panning out, then I think this argument of rates influencing economic growth beyond a point of time, I think we are as I mentioned, we are in a very narrow channel of either down or up. And I think down is almost ruled out now. It was ruled out last time, in my view. I think we should focus on the reforms and the implementations of many things which are in process. And they should actually lift, quote-unquote, animal spirits, deleverage balance sheets both for corporates and banks. And over time, utilizations are climbing up. I don't think they're as bad as it was maybe 2 years ago, a year ago. So some of these things we'll just have to kind of sweat it out. And we are a globally linked economy. Both from a exchange as well as liquidity perspective, we cannot be so out of step with what the other policies the banks are doing. So I think we are in a very, very tight range. I would think for the next 4-6 months we are in this zone, and I think the only thing will be if growth picks up, we might actually be requesting RBI not to raise rates.
Let's wait and watch. Ajay, I think the common theme coming in out here, and certainly seems to be the right thing as well, that at best what the RBI can do is sound neutral. It's very difficult to probably do that in light of what's happening across the world and what the peer countries are doing as well. China, South Korea probably has its first rate hike in a while now. And as Upasna referred to as well, with the prices of commodities moving up, I think vegetable prices have moved up in the last couple of months as well. What would the equity markets be hoping for, if at all? I mean, or is this a status quo from an equity markets perspective? Don't really bother about what the commentary is going to come in because you already priced that in.
Yeah, I think it is largely priced in, Neeraj, so not too much of expectation. As Rajeev was saying, I would totally agree there. And, I think we have to wait and watch. Overall, what RBI will say is that there is still a liquidity overhang, and we'll make sure that is reduced by March end. So more OMOs, the rupee, they will say we let the market forces decide, even though there would be a stated policy on the rupee. Since the last policy has seen appreciation, Rajeev Kumar of Niti Aayog also criticized the RBI recently on that of hurting exports by allowing the rupee to appreciate. So don't expect too much on that front. Overall, they'll talk a bit about the global scenario and the Fed hikes. And given that scenario, some kind of liquidity going out from emerging markets, and what is RBI's viewpoint on that. I think that's what the market will look at. But overall, 2 or 3 numbers. One would be the GDP number. What is the GVA projection for the next 2 quarters and for the year? What is their inflation expectation? What are their surveys showing and pointing towards? And then what is the liquidity policy of the RBI? I think these will be a few of the things.
Right.
They will express concern on the government's fiscal issue. Yeah.
Sure. Okay. That's a fair point. My only question, and maybe Pradeep would have a thought for Upasna as well, but Shiva, I just want to come to you first. Wouldn't the RBI want to sound, accommodative enough on the liquidity front? Because that's one thing that has tightened considerably. We're probably entering a month which is also going to see enough liquidity demand, and OMOs, if any, were conducted, the liquidity that needed to be sucked out, probably done in June or July. I don't remember which month. You would probably have a better handle there. Do you think the commentary on RBI being accommodative enough on the liquidity front would be necessary, if not sufficient?
So the stated RBI policy on liquidity for the last couple of years has been neutral liquidity. But of course, they have never managed to achieve that because liquidity was quite a bit in deficit when they made that announcement. And of course, after demonetization, it has been, for the most period, substantially in excess. And this is the first time, perhaps, they're very close to neutral liquidity. So even if they make the announcement that, we want to sort of calibrate liquidity so as to remain neutral, I think markets will be okay with that. I think any signal that liquidity doesn't get tighter from here on would probably be at the margin somewhat positive. But I don't think liquidity will move bond yields. At best, it will move very short money market rates. But beyond that, we are not really seeing liquidity as a big driving factor. I think even though we have seen the remonetization go away, you must remember that there is still a lot of existing cash management bills, etc., which is still part of MSS outstanding there. So really speaking, short-term liquidity can be very easily managed by the RBI.
Yeah, I think that was a very important statement that RBI made and has been sticking to it, that they'll keep the liquidity to a neutral level. Upasna, what we are trying to really figure out now, how the liquidity will move over next few quarters, how the rates will move, and what Mr. Ahuja said, that probably we'll see a pause for a few quarters and a few policies, and thereafter there could be a move up. There has been a demand that RBI should probably communicate more clearly, like some of the banks do, in terms of a dot plot that Fed releases or some kind of a glide path they can talk about. Do you think it's possible at this point for RBI to move to that next level of communication?
Well, I don't think, at this point in time, RBI would really, unlike most of the market participants, I am not really expecting much clarity on the liquidity stance as we go forward. Well, I think what really is important is to keep in mind that the OMO sales, if at all that happen, in the months ahead, will be a function of how RBI's FX forward book management would be. So, as we go forward, we know that forward book outstanding is around $32 billion. With the next 2 months, almost $5.5 billion of forwards which are due for maturity. And again, March also has around $9 billion of maturity. All in all, around $22 billion is due for maturity in the next 6 months or so. Now, the question here is whether RBI really intends to take full delivery of its forwards or not, and that is where it will take a call in terms of whether OMO sales further are warranted or not. But keeping that aside, liquidity in general, of course, is expected to remain on the tighter side as we go ahead. Of course, we have the advanced tax flows, then we'll have the GST outflows, then currency in circulation also seasonally tends to be a little high on at these during these quarters. So all in all, yes, liquidity will be tightening towards more and more of neutrality. But having said this, I do not expect any clarity from the RBI on the liquidity stance at this point in time. They will continue to maintain the existing stance of the fact that they will be monitoring liquidity and that they intend to achieve liquidity neutrality over a certain period of time. But I don't think there's going to be any excessive commentary on the liquidity stance at this point in time.
Okay, and Upasna, do you think they'll tinker with the projections of GDP, GVA, what they really project now, or CPI? Going by the fact that in last policy itself, they had revised both these numbers, inflation upwards, and GVA was revised 70 basis points or 60 basis points downwards.
Well, I'm not again expecting any change. I mean, they've recently revised it. And in this policy, of course, if you recall for GVA, they had revised it down to 6.7% in the previous policy. Our own expectations are closer to 6.5% for this year. But at this point in time, clearly, going ahead, RBI was very, very optimistic in the previous policy as well for the H2 of FY18. And I think they will retain that optimism and try and retain their 6.7% at this point in time. At the same time, even for inflation, they had given a range of 4.2 to 4.6%. Again, I don't see any reason for them to change it, because when they really revised it down earlier for H2, revised the inflation estimates upward by 10 basis or so in the previous policy. Already for October, we knew that the numbers are going to be below 4%. It's only the November reading which was expected to touch 4%. So I think 4.2 to 4.6% through March 18 is a reasonable estimate, and we do not see any revisions there.
Okay. 3 minutes to go before we hear the policy statement or actually get the first flashes, and then we'll have Ida, of course, come in as well. Must bring up the bond yields and off from the highs of the day, but 7.063 now for the bond yields. Remember the equity market, this is the bond yield really, just coming off in the last few minutes of trade. Bring up the equity markets too, and I think they've worsened. The Nifty is now at 10,054. The Nifty Bank is down about 0.5% as well. This probably has nothing to do with the policy, but just ahead of the policy statement coming out, some nervousness out there. Not so much in banks, but for Nifty by and large. And as I said at the start of the show as well, the index moving down today probably has little to do with what the market expects the policy to do, but more to do with what's happening on the global front. I just don't know, just get a feeling. We'll just take a very quick poll now from our guests, because the policy statement should be out anytime, but just a feeling, the growth dynamics not back full steam, liquidity conditions very tight, bond yields harden. I don't know if they have the window to really sound too hawkish. They probably will have to sound neutral. So what you mentioned that they'll have to be at best you expect a neutral tone. Yeah. Probably that could be the case.
Yeah, and I think they very clearly highlighted the risks from an inflation perspective last time.
Right.
They also highlighted the risks from the GST and the PSU balance sheet issues last time. And I think they'll reiterate some of the things which are still open. Clearly, global policy, clearly oil, inflation will be still concerns for them.
Sure.
I think the GST transition and recap are positives. And they might actually just continue with the same guidance and then wait and watch.
Sivakumar, 20 seconds before we get the statement out. Final thoughts before the policy?
Put me in a very difficult spot, but I would expect a neutral stance and no change.
Okay, no change in stance. Let's wait for the statement more importantly. But yeah, as we said, this is essentially the status of the different asset classes before the statement comes out. Should be coming out any moment now. About 10 seconds to go. Watch out. The common theme that I think all our guests have said will be status quo. The tone at best neutral. Let's wait and watch if the RBI obliges. The index lying very, very flat. Pradeep? Final thought.
We are still waiting for it, and I'll be looking at whether there is a consensus decision after all, because for a while now there has been at least one dissenting vote. Even when they cut, there was one vote that went against the cut, and last time around also there was one dissenting vote against the status quo. So while today's policy statement will be
unchanged.
So that is the policy right now. Let's wait for the details and see what exactly has been discussed. I'm still not able to open the policy statement.
No, but I have it on the terminal. Okay. It says unchanged. Let's just pull up the bond yields once. I don't think there's too much of deviation. Again, so the decision is as per expectation. Now we wait for the tone, and I think Ira would have a good sense of what the tone is. So we'll get across to Ira as soon as she is available. But I would presume that this is as per expected lines. The yield's not really moving too much. It may show a bit of a drop, but really I don't think there's too much of a reaction thereof. Siva, your initial reaction? I mean, I just have this one flash. The repurchase rate has been unchanged.
Yeah, I mean, yeah, so I mean, which is on expected lines, and so market shouldn't react too much. It's already priced this in. It has priced in a reasonably neutral to hawkish tone. So unless there's a very significant deviation in the tone or in the commentary, I would imagine that bond yields should not substantially move from here. That would be my call. Yeah.
Retains the neutral monetary policy stance as well. Mr. Ahuja, your initial thoughts? Nothing?
Pretty much the same.
You can't say anything different, but yeah.
So I think the CPI forecast has inched up a bit because their estimate is now 4.3 to 4.7 in Q3 and then Q4. If I remember it correctly, last time around it was 4.2 to 4.6. Yes, last policy statement I can see it was 4.2 to 4.6. So marginal increase in the inflation projection, which is definitely not a good news.
Okay, Ajay Bagga with us. You just heard that small uptick in inflation forecast expectation as well. A quick thought, Ajay?
Yeah, I think it's a past event now. We can analyze it for the next half an hour. After that, it doesn't matter. I think a bigger issue, Neeraj, will be the looming shutdown of the US government on Friday and the Brexit collapse in talks in the UK. That's what is spooking markets more globally. And we have seen Europe opening weak. So I think equity markets, more the global issues. This was a done deal and it's got factored in already.
Okay, so Dr. Ravindra Dholakia still voted against it, and he asked for a 25 basis points cut. I'm not surprised.
Are you surprised? That's the question. Okay, okay. I'm told Tanvee Gupta, Jain is also with us, but Upasna Bharadwaj, firstly to you. The neutral stance, I don't know if the language is dovish or hawkish. I think Pradeep and Ira will probably tell us more about it. Maybe Pradeep has some thoughts too. But your initial thoughts, Upasna?
Yeah, again, of course, the rate stance is obviously the rate decision is in line with expectations, and the fact that they have, marginally though, but revised up the inflation trajectory, and they have raised concerns from what I see briefly in terms of fiscal concerns. I think it is broadly in line with what we were expecting. All those concerns that we were raising, that has been pointed out by the RBI, and of course that clearly points to the fact that RBI would be watching these factors.
Upasna, allow me to come in, Upasna. I just have to go across to Ira, who's at the RBI headquarters. She then has to go for the press conference as well. Ira, what are you gathering?
A very neutral policy, Neeraj. So as you know by now, there's been no change in either the interest rate or in the fact that they have maintained the neutral stance. If you look through the policy statement as well, it's very similar to what it looked like in October. The only thing I would draw your attention to is that one paragraph where they talk about why they have maintained the neutral stance. So they clearly say that there are upside risks to inflation, etc. But they also mention the fact that there is an output gap which has persisted. So the only glimmer of hope I would take away from that policy is that mention of the output gap when they're talking about the neutral stance. So while for all intents and purposes, if you go by their inflation forecast, it doesn't look like they're in a mood to cut rates, but they haven't entirely shut the door completely, perhaps on some small hope of the requirement of another rate cut. I think that rate cut, if at all, would come in if the growth scenario does not play out as they expect. I'm just going to take a couple of minutes to explain what I read from the statement on both inflation and on growth, and then I'll allow you to go back to your guess. I think on inflation, both in terms of the length of the paragraph devoted to inflation and in terms of the number of factors that they talk about, all upside risk to the inflation side, the MPC's focus is very squarely there. So they've talked about the fact that food and fuel inflation, which have a bearing on most household costs, costs have already started to rise. They talk about the fact that inflation expectations have firmed up in recent months as well. Then they talk about the fact that there is uncertainty on the global front, both on global commodity prices, but also on developed nation monetary policy and tightening of monetary policy in developed economies. Then they, of course, also talk about the fiscal pressures, and in fiscal pressures, they talk about farm loan waivers. They talk about the fact that you've rolled back on excise duty and that you have cut rates on certain items under the GST, all of which will have implications for the government's revenue and could lead to fiscal slippage, which has attendant implications for inflation as well. So talking about all of that, they've raised their inflation numbers by 10 basis points, not much. So in the last policy, they talked about 4.2 to 4.6 as the band for inflation in the second half. Now they're talking about 4.3 to 4.7. On growth, actually, I have to say that you get a sense that even the MPC is not clear on what is happening on growth. So they talk about factors, some encouraging factors, and the factors that they talk about is some pickup in credit growth, the fact that companies are raising more capital from the market, the fact that PSU banks have been recapitalized, that there is some hope that these large stressed accounts would start to get resolved. All of those could have implications, positive implications for growth, but they also acknowledge the fact that agriculture is likely to be a bit of a weak spot in this particular year, given the Kharif and the Rabi sowing data. So they talk about that. They acknowledge that there has been weakness even in certain services segments like financial services. So I get the sense that the MPC is still also, just like the rest of us, not clear on what is happening on growth, which is why they have kept that neutral stance and put in that word about the output gap in that stance, even though at this point their focus is squarely on inflation, which is reflected in the fact that there is no change in rates. Just one very small mention before I run off back to the press conference is something unrelated to monetary policy, but important, and that is that the RBI has decided to rationalize the merchant discount rates on debit card transactions. That is something that will not be discussed in market hours, I know, Neeraj, but an important move in any case.
No, I take on board that point, Ira. Thanks so much, and we'll see you at the press conference as well. But thanks for giving us a complete lowdown on this. So that's the summary from Ira Duggal, really, on all that's come about. Important points, some of those. Just want to get in Tanvee Gupta, Jain, Chief India Economist at UBS Securities, on the show as well, with this opening question that at least I have. Tanvee, in point 18 that the RBI has given out in this release, they talked about how in MPC's assessment, several significant developments which augur well for growth prospects. And they've cited the few points that Ira was talking about. At the end, they are saying that the MPC notes that the impact of these factors can be buttressed by reducing the cost of domestic borrowings through improved transmission by banks of the past monetary policy changes. Your initial thoughts on the policy and this important point about growth as well?
Okay, if you look at the policy was exactly in line with what we have been expecting. We were saying status quo in rates and neutral policy stance. The three words which I would like to see or would have seen from the policy, which the correspondent just mentioned. They mentioned about oil, they mentioned about fiscal slippages or the risk of fiscal side. They mentioned about what's happening on a fiscal scenario, and definitely what is happening on the growth. So if you look at what's happening on the growth, and they did mention about the negative output gap, which could be one of the reasons why inflationary pressures are still kind of contained, even though they have revised the forecast by 10 basis points for the second half. But overall, if you look at the overall feel which we are getting from the policy side is, the main reason why the RBI is still maintaining neutral stance is that the growth recovery, even though we have seen an upside and the trend has been on an upside, it's still at a very, very fragile state. The investment cycle recovery has still not happened. So you can't be hawkish at a point when your overall economic recovery is still tepid. So definitely we are seeing signs of improvement in the overall economic growth, but the magnitude and the sheer movement in economic growth is still tepid at this point, especially on the investment side. So I would say, I think a very, very balanced policy, mostly in line with expectation. The point 18, which you just mentioned about growth improving and the growth scenario, and they gave a lot of encouraging signs on where the growth is picking up, is kind of highlighting that why the neutral stance is still needed at this point, and the RBI need not turn hawkish, which will be too premature at this stage to sound very hawkish when the economic recovery on ground has still not taken off.
So, Mr. Sivakumar, post this policy and a clear, revision in inflation target, where do you really see the 10-year yield in next 30 days or so?
I think given that the policy was on expected lines, we don't expect anything dramatic fallout of the policy itself, of course, barring any announcement during the press conference which changes the tone. And therefore, the market will go back to what it has been looking at over the last couple of months, which is oil and fisc. And of the two, of course, the fiscal will be the most immediate driving force over the next month or so. So I would say that the most important thing is to look at how much is the expected fiscal slippage for the current year, which we should get to know in the next few weeks. And then, of course, whether the government revisits the whole FRBM trajectory, which we should get to know in the budget. So over the next, let's say, a month and a half, 2 months, I would say the discussion on the fiscal will dominate the impact on bond markets.
Okay. I think RBI still expects banks to kind of pass on the cuts that have been affected so far. Do you think there is room, Mr. Ahuja, for banks to really cut lending rates, even though RBI is not really willing to accommodate?
Actually, I think over the last 3 to 6 months, borrowing rates in the market or lending rates by the banks have come down. If you see the housing rates, they're sub 9. Many large corporates with strong credit ratings are borrowing at much lower rates. In fact, many of them are going to the CP and the bond market. So effectively, I think the lending rate regime has shifted down. Also, there's not been much credit growth overall for the last 6-9 months. So some of that is happening from a demand-supply perspective. And I think as this eases out, because I think in the last 3-4 weeks, deposit rates have started inching up. You saw bulk rates being hiked by many PSU banks. And I think we sense that at least the run-up to March, there will be some pressure on deposit costs. So I don't think there's much room for banks to already cut lending rates. Yes, I think we are all taking a look at what our mix of cost of funds is and then effecting those changes. We have been making 5 to 10 basis points cut at almost every regular intervals on the lending rate side on an average. But actual market borrowings is coming lower and lower right now.
Okay, just need to bring in the market element here before the RBI governor starts speaking, because we are now trading at the lowest point of the day. 10,036 and counting. We are falling quite rapidly. The intraday of the Nifty would be helpful there. Led predominantly, yes, by the commodity plays, so the likes of Hindalco, Vedanta, etc. But HDFC has fallen quite a bit in the last few minutes of trade. I'm guessing that is putting pressure. State Bank of India has come off a bit. So these are heavyweights which are coming off and putting that pressure. Bosch is down about 3.5%. These were not stocks that were amongst the top losers at about 1. So there's a bit of a pressure that is happening right now. As we speak, of course, the RBI governor about to start speaking, so we'll cut across as well. But remember, the markets are under a fair bit of pressure right now. Equity markets in particular, bond yields, they're okay. Status quo, I presume, but the equity markets certainly under a lot of pressure. We'll hear from the RBI governor in just moments from now. I don't know if somebody will throw in a question about Bitcoin, because RBI yesterday did come out and say and caution people about Bitcoin as well. So you never know, even that could happen. Yeah, let's just wait and watch what the governor has to say. And
the other key development that Ira was talking about, now that RBI is going to kind of regularize or rationalize the prices on debit card transactions. Yeah. What the statement also mentions is that a detailed release will come out today itself in the evening. So we'll probably know to what extent would the consumers get relief on that, and what happens to the banks also then.
Hey, from a consumer perspective, very, very important, quite frankly. Okay, I think he's just about to start speaking. Let's
good afternoon, everyone, and thank you for coming to the 5th bi-monthly of this fiscal year. As you know, today the Monetary Policy Committee decided to keep the policy repo rate under the liquidity adjustment facility unchanged by a majority of 5-1. It also decided to persevere with a neutral stance of monetary policy and reiterated its commitment to keeping consumer price index inflation at the target of 4% while supporting growth. In arriving at this decision, the MPC took note of the upside pressures from food and fuel prices on evolving cost of living conditions and inflation expectations. Our surveys indicate that corporates are also contending with rising input cost conditions and higher risks of pass-through to retail prices in the near term. In addition, the committee expressed concern about the implications for the inflation outlook of A, global fiscal of possible fiscal slippage, and B, global financial instability heightening asset price volatility. However, the MPC also expected the usual seasonal moderation in the prices of vegetables and fruits and the lowering of tax rates by the GST Council to mitigate some of these pressures. The MPC's decision was also conditioned by recent developments that augur well for growth prospects going forward. In the primary capital market, resource mobilization has increased significantly, which will add to demand in the short run and boost the growth potential of the economy over the medium term. Recent reforms have contributed to an improvement in India's ease of doing business ranking, which should help sustain foreign direct investment. The MPC also took note that large distressed borrowers are being referenced to the Insolvency and Bankruptcy Code proceedings. Public sector banks are being recapitalized, and this should enhance allocative efficiency. In the view of the MPC, all these factors should help to create conducive financial conditions for nurturing higher growth. Turning to recapitalization of public sector banks, the Reserve Bank has been working closely with the Department of Financial Services, Government of India, to finalize for each bank, one, the extent of funding to be raised by the bank, and two, the amount of recapitalization bonds to be placed on the bank's balance sheet as government's equity contribution. As announced by the government, the plan will be differentiated across banks. In particular, recapitalization bonds will be front-loaded for banks that have managed their balance sheet strength more prudently and can use injected capital to lend besides providing for legacy asset losses. The other banks will receive government contribution based on their resolve and progress towards reform in a significant and time-bound manner, such as becoming slim and trim through adoption of simpler, better focused business strategies, as also possibly non-core asset sales. Governance reforms for all public sector banks will also feature as part of the overall plan. To summarize, this will be a reform and recap package and not just a recap package, so as to ensure that this money is used to strengthen public sector bank balance sheets and that we don't sow the seeds of the next boom and bust cycle of lending. Details will be released in the coming days by the Department of Financial Services. I will now request Dr. Acharya to say a few words.
Thank you, Governor. Good afternoon, everyone. I'll talk about the prevailing liquidity conditions. The liquidity conditions have continued to normalize gradually during the year. The overhang of liquidity surplus in the banking system post the withdrawal of specific banknotes or SBNs in November 2016, which had touched a peak of close to rupees 7.96 trillion at the beginning of the year, has since come down. Banking system liquidity has in fact been moving towards neutrality as the currency in circulation has expanded by rupees 7.6 trillion during the period January 6th of this year to November 24th. During the year, surplus liquidity was high due to two reasons. One that is well appreciated, the overhang from withdrawal of SBNs, and second, which is somewhat less appreciated, the foreign exchange operations. The surplus liquidity was absorbed on a durable basis through a mix of open market operations or OMOs and issue of securities under the market stabilization scheme. In addition, variable rate reverse repos of different tenors were used to absorb the short-term surplus. Going forward, it is expected that the liquidity conditions would be marginally still in surplus by end of fiscal year 2017-18. Given the trends in currency in circulation, it is expected that system liquidity may reach neutrality in the first half of 2018. Of course, these are projections and there are some uncertainties around these, but this is what we see as the likely outcome based on data available. The Reserve Bank will continue to manage the evolving liquidity conditions through a mix of variable rate repo and reverse repo operations of various maturities. These are for handling short-term liquidity fluctuations. We will also consider open market operations in case the liquidity is required to be injected or absorbed on a durable basis. Thank you.
I just want to refer attention to one of the announcements, part 2. This is regarding the implementation of the report of the working group on hedging of commodity price risk by residents. So as stated there, we have already placed the report on the bank's website on 16th November for comments, and we intend to come out with our final guidelines on this by January 15th. As you might be aware, the current regulation is based on a report submitted in 1997 by the RBI Gupta committee, and a lot of changes have happened. So several recommendations have been made by this group, and we hope that we will put in place a set of regulations that are more suited to the current framework in place. Thank you very much.
Mr. Kanu. Thank you, Governor. If you take a look at the part 2, regulatory, developmental and regulatory policies, there are two significant announcements that are being made. And the first is pertaining to the merchant discount rate. As you would have noticed, the retail payments in the recent times has gained significant growth. And within that, the card payments have also increased manifold. And again, during out of those card payments, the use of the debit cards in the POS, that is the point of sales, that has significantly increased. To give you a flavor of the kind of increase that has taken place, in 2016-17, the percentage usage of debit cards at the point of sales was in volume terms was 21.9%, and that is now it is almost at that stage. So we thought that it is about time that a further push is given to that, and one of the ways which we thought will achieve that objective is the rationalization of the merchant discount rate. And especially this is intended to widen the network of merchant establishments which will accept the point of sales. We have been guided by twin objectives in this. The first is that the acceptance infrastructure will accept it more happily, and it should also leave money on the table for the stakeholders so that they are interested in the game to invest in technology and other things. It has many salient features. That the previous system of ad valorem rate, it continues, but the slab system has been done away with. We have gone by the merchant category, so which will be very simple to administer. There is a limit also on the card transaction. And the third aspect is that a differentiated MDR for asset-light infrastructure has been put in place, which will be slightly less. So with this, we believe that the debit card usage at the POS terminals, especially for the small merchants, will gain further boost. There is also another policy announcement relating to the external commercial borrowing. As you would be aware, when it comes to refinancing, the bank branches or the WS of the Indian bank branches abroad, they were not allowed to refinance the ECBs. Normally what happens is during the ECB, when it is contracted, is for an average period of 5 to 6 years. At that time, maybe it is not a viable unit, or it is at the nascent stage, and the foreign investor doesn't have an appetite also to take a very long-term risk. So they prefer to give it for 5 to 7 years. When the cash flow starts coming, the Indian borrower is in a position to access ECB or refinance it at a lower rate. And the current instruction is if the all-in cost has come down, in that case ECB can be refinanced. But the Indian banks were kept out of the purview of this for some reason which was very relevant at that point of time. So now in order to give a level playing field, we have said that along with the foreign banks, the WOS of the Indian banks and their branches overseas will also be allowed to extend refinancing facility to the Indian corporates, which is a very significant step. Thank you.
Kanungo. We'll take a few questions. Start with Financial Express.
Yeah, good afternoon, Governor. So the inflation estimates have been nudged a bit higher to 4.3 to 4.7% in the second half of the year. Now, at the same time, you have mentioned that the second quarter growth has been lower than what was projected. Now, we have seen that the growth has, after bottoming out for 5 consecutive quarters, the growth started picking up in the second quarter. Now, let's say if the growth doesn't pick up further and it continues to lag, at the same time when inflationary pressures remain, what will have more prominence here for RBI's policy decisions going ahead?
We have a neutral stance, which means that depending on the data flow in the coming months and quarters, will determine what we do regarding the policy. So the neutral stance is there for a reason, that all possibilities are on the table. And we would look carefully with both the inflation data and the growth data that comes in the coming months. The changes that on our inflation projection is at the end of the day very small. It's 10 basis points compared to the October policy. And we are still retaining the growth outturn for the full year at what it was in the October policy. Business standards.
Thank you, Governor. Sir, liquidity, because of drying up of liquidity, banks have already started raising their bulk deposit, etc. rates. So you still expect transmission? Bond yields are rising.
You should look at the existing rate of the bulk deposit and where it has been increased to, and then it's more of a qualitative assessment rather than a quantitative. To the best of my knowledge, that wholesale deposit rate was very low in the first place. Secondly, I don't know what you mean by liquidity drying up, because our weighted average call rate continues to be below the policy repo rate. So to me, it's not at all clear, and we are still undertaking a fair bit of reverse repo operations. So liquidity drying up, I think, is just a wrong definition of what you are saying. You want to add something?
Yeah, I think that perhaps the market is adjusting to the fact that we have been in remarkably surplus conditions for a while. But I think we are nowhere close to having reached neutrality. If you were neutral, some days you would pump in liquidity, some days you would absorb liquidity. We are still essentially absorbing liquidity, as Governor said, to the tune of 20,000 to 70, 80,000 crores on a pretty persistent basis. So, and I want to stress one thing which I mentioned in my remarks as well, which is that the FX operations in terms of buying dollars in the earlier part of the year were substantial. They injected close to over 100,000 crores of rupee liquidity from RBI on top of the demonetization-induced liquidity. In a textbook operation, as soon as you inject liquidity, you would actually sterilize it with an open market operation, because otherwise you lose control of your monetary policy. We have done this time with a lag, because we were waiting for the liquidity conditions post demonetization to normalize and see where the currency in circulation stabilizes. But a lot of the open market operations that we did, in fact, I would say the quantum was essentially in line with the FX operations that we undertook. And when we cancelled the last OMO, it was effectively around the right number, and so we could have gone slightly above or slightly below, and we chose to end slightly below. Thank you.
Thank you, sir.
Good afternoon, sir. What is the percentage of bank accounts that has been where Aadhaar seeding has been done? We have to do it by 31st December. So what is the status now?
We don't have that number as such. We don't have the number of that's not been collected yet.
How difficult is the task going to be? That's the question. I mean, by 31st December, we have to do Aadhaar seeding. How banks are prepared, basically, that is the question.
So the banks, of course, there are, if you look at the way the seeding has to happen, initially we have said that on the basis of demographics, they can complete the seeding. So that can be done in a large, for a large number of people in one go. So that we don't see as a problem. Ultimately, of course, they'll have to actually do the biometrics. So that will take some time, but I think going by the demographic and so on, that is possible to be done on a large scale.
Thank you, sir. So, in the para 17, you mentioned about keeping the keeping in mind the output gap dynamics. The MPC decided to continue with the neutral stance. Does that mean that if the MPC considered shifting of stance, and it is only the consideration of the output gap that made you keep neutral? And if there is going to be a kind of acceleration growth, what happened in the last quarter continues, that the next move could be shifting stance probably as early as February?
You know, we did not consider shifting the stance because nothing between October to now was significant enough in terms of the macro outcomes to warrant that. And as I said in the first question that was asked, that we will look at the data in the coming months and the coming quarter or two. And you know, decide on the policy based on that, which is exactly what the neutral stance enjoins us to do.
Thank you, Governor. You mentioned about the bank recapitalization plan as a reform and recap package. When do you see the next cycle of lending to kickstart as such?
Actually, you know, in the latest data on bank credit and adjusted bank credit and total financial resources flows suggests that we are already on the uptick in terms of the credit growth. So credit is already flowing in more than what it was the case in October, and as the economy picks up, the demand for credit should go up, and there is enough supply to ensure that the lack of credit is not in the way of supporting higher growth. So the uptick in credit growth has already happened.
So we can probably take one more question.
So banks have continued to report fairly material divergences in bad loan reporting for FY17. There's a bit of confusion on what exactly is going on. Is there another round of an AQR? Is it that restructuring schemes are being looked at? Because in private conversations, bankers tend to say that the RBI is moving the goalposts and hence these divergences are coming. Can you please help us understand, sir?
One, I think I must clarify two things. Divergences on the basis of inspection used to happen in the past as well. One. What has changed is the transparency that we have brought in the form of disclosure of divergences when they are more than a certain percentage. So that's actually changed the narrative in terms of this. So this divergences used to happen even prior to AQR. It's happening now. Second is, I want to make it very clear there has been no change in goalposts. The rules are as they are. We have assessed the bank's classification based on the rules as they are today, and we found that in some of the cases they have not applied the rules correctly. That's it.
Take one last.
Thank you very much, sir. You said you retained the GVA at 6.7%. Given that, what would your projection be for Q3 and Q4?
they're going to be 7 and 7.8. So we're on the up trip from now.
Thank you.
That's the sum and substance of the policy. We'll take in initial thoughts from all our experts as well, because we've heard what the governor had to say. The last question, pretty interesting as well. I think the ask number for Q3 and Q4 in order to meet those FY17 GVA targets is steep, but the RBI seems to be confident that will happen. But first, the banker's perspective, Mr. Ahuja.
No, I mean, I think he's pretty clearly laid out that he's neutral, he's data dependent. There are enough things which are positive from a construct perspective. Outlined the entire recap, GST, the movement of business, the ease of doing business, which is a reference there, and the primary capital which is being raised. On the watching side is really the inflation, the fisc, and what happens in the global policy. So I think those things are going to be around with us when we meet in February as well. And I think so the RBI's perspective, I think what to me was the most important thing was that headline inflation of 4% is still what their kind of objective is, which is reassuring that they're not giving up that as I keep saying, you know, getting inflation under control. Second is, I think the comment which on the Deputy Governor made on the liquidity side, that we are in a neutral position. Actually, we'll get to a neutral
position. Yeah.
And that he also mentioned about injecting or absorbing more durable liquidity from OMOs. I think there was a comment where he actually said injecting or absorbing. So to me, now it's up to the other aspects of the economy to actually start kicking in. And, you know, by and by they will kick in. And the RBI will do the right thing to keep, from a liquidity perspective, that quote-unquote neutral stance, so that there are no very short-term volatile rates which can actually misprice resource allocation.
So in fact, both Nifty and Bank Nifty were trying to recover during the press conference, but now has slipped to the lower levels. Mr. Sivakumar, what is the takeaway, you know, the policy on way move or the liquidity neutrality projections that Mr. Ahuja just discussed? How do you really see the yields moving?
Well, I would kind of agree that, you know, it's still the exact neutral point is still probably way away, and I think the RBI Deputy Governor did say something like middle of next year, next calendar year. So I would imagine over the next 6 months we should get towards neutral liquidity. The other interesting takeaway for me was the Q4 GDP projection of 7.8. That will be a huge acceleration from the current levels. And if that were to happen, and let's say we are at the end of the current FY, and we are at 7.8 GDP, and if RBI is right, somewhere maybe closer to 4.5 inflation, the narrative suddenly on monetary policy will look very different if we are suddenly growing close to 8% with close to 4.5% or higher than 4.5 inflation. So I think over the next few months, that's exactly what we'll be looking for a direction for monetary policy. But like I said earlier, I'll stick by my stance that what is going to drive bond yields is going to be the stance of the fisc.
Well, no surprise there. Tanvee, final thoughts from you?
If I look at the press comments, I think very, very balanced, but I'm a little surprised looking at the GDP numbers and the quarterly trend, what they are hinting about, somewhere around 7 and 7.8 kind of growth over the next 2 quarters. I think we do see downside. In fact, we are at 6.5% GVA basis for our growth numbers for FY18. In that scenario, I think we will surprise slightly on the downside on growth front versus where the RBI is right now in terms of overall growth forecast. But yes, on the policy side, we are expecting status quo. I think the best thing what RBI is highlighting, they are cognizant of the risk, and they are also highlighting reforms which are needed for sustainable growth recovery. For example, PSU banks recapitalization, they said it has to come with reforms, and we know that it's not an investment demand can pick up because the banks are being recapitalized, but at least the supply side conditions are being created in the sense they are being made conducive so that as and when demand recovers, at least the economy is well prepared to take it to the next level. So yes, so I think RBI is very much data dependent. Next move depends on data, especially on the fiscal side and how global commodity prices behave. Our view is that RBI will keep rates on hold. But again, oil and fiscal policy remains the key variables to look at.
Okay, Tanvee, thanks for joining in and giving us that perspective. Just taking an initial thought from Vivek Rajpal before I take in a final thought with Mr. Ahuja as well. He's, of course, Southeast Asia and India rate strategist at Nomura, joins us right now on the show as well. Vivek, what would your thoughts be? I mean, I don't think there is too much of a deviation in the minds of anybody that rates, if at all, at best are on hold. I don't know if there is a case for, or even there is a mention in any way whatsoever about a hike being there, a possibility in the near term.
Absolutely. I think what is most interesting is that market went into this policy with the expectation of being neutral to hawkish policy from Reserve Bank of India. And the outcome was broadly in line with expectation. I would think it's more or less neutral, on the neutral side of expectations. Purely from rates market perspective, I think we should see consolidation in bond markets at these levels. And this monetary policy outcome is more or less a non-event. From here on, key focus will be on the fiscal policy and the global commerce.
Okay, so the next movement or the next step of RBI will probably depend upon the government stance on the fiscal front. That is what our experts are kind of concluding. Mr. Ahuja, if you now also look at the other thing that we discussed, RBI is trying to regulate the cost of card transactions.
Sure.
What would be your view on that? It could be slightly negative so far as the other incomes of banks is concerned.
But I think this is clearly for many banks not a very large part of the other income, but actually what it does is it brings a lot more customers and merchants and into the transaction side of the bank. And I think that's overall positive. I also think that there will be an equilibrium in the market in terms of the cost revenue dynamics. We clearly do not just do POS just for the merchant discount rate. The idea is to engage with the merchant to be able to build a transaction history and to be able to do working capital for the merchant basis the kind of electronic payments he's receiving. So overall, I think the business models will have to be more robust. If you're just relying on other income between MDR, I don't think that's the way most large players do neither, and we don't either. So we have to look at a more holistic merchant banking in, right from deposits as well as lending as well as processing the electronic payments. And I think the direction of travel is actually more important in my view, that the number of transactions which come at the merchant level more and more, whether it's a hard POS or a soft POS, is just going up. And I think that for us is a very important thing, because that will lead to a second round impact on other services we can provide through our partners. And we have a fairly decent partner group which actually together we do this business. So I'm not that fussed about other income because it's a very tiny part of what banks do.
RBI actually wants to grow that market. By the way, Nifty Bank is down 280 points now. It has
that's the lowest point of the day
last
today.
few minutes.
And I think from a perspective of what these rates or the lines at which the Nifty Bank is, I think it's very close to the moving averages as well. Let me just bring that up before I get into our next guest. Mr. Ahuja, take a moment to thank you, of course, for being with us today on the show. Thank you so much for dropping by. I look forward to have you, of course, the other time as well. By the way, the Nifty Bank too, sub the 50-day moving average, very close to the 100-day moving average. Keep an eye out for the Nifty Bank, quite frankly. Now, Vivek, before we let you go, a word on what do you expect the rate trajectory to be like? And this is a non-event. I take on board your point that we were entering into this policy believing that the best case outcome would be a neutral policy, and we've gotten that. But the world around us, the peers, all of them are in a rate hike trajectory. Inflation expectations are not as benign as they were maybe 3 months or 6 months ago. Would you presume that the best case is a status quo for the next couple of policies, and there is an outside chance or a real chance that we may have a move on the rates before that?
So when you talk about rate trajectory, are you talking about the policy rate trajectory,
yes,
or
please.
you are talking about the bond markets?
No, policy rate trajectory.
No, I think it will be an extended pause. In fact, if you really if you really ask me, I think I do not see any reason to believe that we should be seeing a rate hike anytime soon. I mean, of course, I agree that oil prices have risen, but if you really look from a global perspective, and if you look at, for example, industrial metals, global commodity prices, they are more or less consolidating. In fact, if anything, they are down in last 1 month. So to me, risks are on both sides. Base case is that they will remain on extended pause. Let's not forget that India operates in a very high real rate environment, and therefore there is no need to act proactively in terms of hiking rates. I mean, I also do not see a big reason for a rate cut, for example, but to me, extended pause looks like a more balanced outcome, and then based on how the global commodity prices develop, India central bank may act based on that.
What would that mean to the rate at which companies or individuals are borrowing, both from the bond market and from the banks? Shiva, what would be your call on that one?
I would say that as long as RBI remains on a neutral stance, we shouldn't see any substantial hardening of yields from here on, barring any other negative surprise. And so therefore we should not see a very large variance in terms of deposit and lending rates. Of course, we have seen some reaction to the tighter liquidity and some of the excessively low bulk deposit rates, as the RBI mentioned, getting normalized. But barring that, we should see rates reasonably anchored, within maybe a band, but reasonably anchored over a period of time. So we are not really expecting this policy or indeed the near term to bring much changes to the rate environment.
Okay, Jem and all of you, thank you so much for taking the time out and being with us. Siva, thanks so much for waiting by through the course of the policy statement as well. Really appreciate this.
Thank you.
Okay, that's sense from all our guests on the RBI policy. And the statement and the commentary thereof. Done deal, event out of the way, but it's having some telling impact on the markets, or maybe the markets are just weighed in by their own pressures, waiting for the policy statement to be out of the way and seeing if there is, if at all, there is a whiff of positive surprise. Because frankly, the PSU banks, Pradeep, yesterday were probably behaving as if there could be something out there. And right now, it's all PSU banks. So maybe you can argue that ICICI Bank and HDFC Bank too. But look at the PSU banks, SBI, PNB, Can Bank, BOB, 2.5% apiece for each of these.
That is surprising because, I mean, IDBI or IOB or a UCO bank going down was fine because RBI governor kind of clarified what the policy on recapitalization will be. So these so-called stronger banks should have managed to hold on, but that is not the case. Looks like, the entire banking sector, the entire PSU banking and also the corporate-focused banks, as you mentioned, or maybe even the retail-focused banks have declined. So it's true, maybe the short traders were waiting for the policy to pass, and now then once they have clarity, probably the fall is just getting extended. Let's bring in our technical analyst here, Rahul Randeria, technical analyst at IFCI Financials, joins us now. Rahul, what's your call on Nifty Bank now?
Yeah, good afternoon, Pradeep. If you look at the overall the daily charts of the Bank Nifty, since last 7 days we have seen that it has drastically came from the highs of 26,200 and currently it is quoting around 24,800. Definitely the setup is deep oversell territory, but looking at the current sell-off, I feel it is most probably because of the global cues as well as the Asian market is also weak, have a deep cut into Asian markets as well as the European markets are also weak. So looking at this, we feel that this current sell-off is is totally based on that global cues. But if you look at the overall charts, Bank Nifty has rallied from the levels of 23,600, it went up to 26,200. The current 60% retracement is coming around 24,600. So definitely I feel that today is the 7th day, maybe tomorrow will be the 8th day. we could see some sort of pausing around the 61% retracement mark. So definitely at these levels, one could try to buy Bank Nifty at the lower levels. But being the eventful month, because again we are having a Fed meeting and then Gujarat election, so one should buy with covering on the downside, maybe buying a put of maybe 24,500 on the downside for the month end, and try to hedge the long position. And one should be happy because the stocks are getting, the prices of the stocks are getting cheaper day by day. So definitely those who want to build up the portfolio for the long term, one should start buying a slow and staggered way now.
Sarvendra, the fact that the index is below the 100-day moving average, how critical is that from a near-term trade perspective, the Nifty?
Yeah, very good afternoon, Neeraj. No, Neeraj, if we go back to our discussion over the last couple of weeks, it does not surprise me. I think we were expecting this to happen, and right from the second week of November, we have been calling that the markets probably will now, there's been a pause and there will be a meaningful correction. So I think 100 days is definitely important as support, but for me, I think a correction which should do at least a 40% retracement to the entire move. And I'm talking about the move from around 7,900 odd that was post demonetization, 7,900 to 10,490. If we retrace that move to around 38%, then I am saying then we've been maintaining a target of 9,700 from that particular point in time. And last week also we had advised to buy that 10,200 put. So anybody carrying that trade probably can carry that trade. Anybody wanting to do a new trade could look at the 10,000 strike now, which is very near the money. Look to buy that around that strike at around 110, 1.5 premium, and look to hold for the end of this month. Anybody holding that 10,200 also can roll down, and with those profits can buy 10,000 put. My sense is that 9,700 could get tested going forward next fortnight, 10 days.
I'm sorry, Sarvendra, but the strategy that we just flashed on the screen was buy 10,100 call. I think what you have advised is buying 10,000 put or even the puts of lower strike and not call, right?
Yeah. I think that's a typo. I would say that buy 10,000 puts. 10,200 put was what we recommended last week. Anybody wanting to hold that can hold with a trail stop loss on cost or roll it down to 10,000 put. And anybody wanting to participate fresh can also look at the 10,000 put between 105 to 110. And that is where I think it is right now trading at around those levels. And I think that put should make you a decent amount of money, because 9,700 in the money, that put should be around 300, 350 rupees by month end.
Okay, so that's a small correction and we regret that error. By the way, Sarvendra, if you have some stock-specific short calls as well, and I would expect your stock-specific trade would be on the short side.
Yeah, absolutely. I think we've been recommending more shorts than buys for the last 1 month. In fact, last week we were all 3 sells. And more or less, I would continue with one name in that. The metal basket looks weak, so Hindalco is one that I'll carry, but I'll go in sequence. The first one that I would like to short sell is Asian Paints. I think clearly now with WTI crude and crude prices staying where they are and probably heading higher, because even after this negative talk for almost now week 10 days, crude prices have not fallen much. 57, 58 probably for WTI has been the range. 62, 63 has been the Brent prices. So my sense is that the WTI prices will be more closer to 62, 65 going forward next couple of months, and crude plays, the users will then get hit. So Asian Paints now breaking the 200-day long-term average and breaking some very decent distribution patterns over the last couple of months. I think from a trading angle, 1080, 81 is what I would say on the downside is possible. Anybody wanting to hold the trade for a month, 10 days, for 15 working days to a month, I think that that target could be well close to 1,000 odd rupees for Asian Paints. But going forward for a week, 1,080 is the target, 1116.10 is a stop loss. These are spot levels, mind you. I'll carry with Hindalco, the metal pack. That's a carry trade from Vedanta and Hindalco pack. Look to now for targets in the region of around 222 to 223 on the downside for Hindalco. Keep a stop loss there at 237.60. And last one is the sell on Siemens, where I feel that the stock could go all the way till 1110, 1112 on the downside. So look to short sell for that target and keep a stop loss at 1161.60 on Siemens.
Okay, let's look at some of the stocks which have slipped further in last minute of trade. Ajanta Pharma is one that should come on your screen, down 2.5% over the last 15 minutes or so. You can see a big crack in Ajanta Pharma. Also, Shankara Building Products continues to slide down, is now quoting at 1908, down by around 16%. We've also seen some additional selling at Union Bank of India, also Hindustan Zinc, Jindal Steel and Power. These are a few more stocks where we have seen some intense pressure building actually. Well, we are approaching the last minute of trade now. Rahul, would you have a BTST or maybe a positional trade on individual stocks?
Yeah, I have one BTST and one STBT. The STBT is Wipro. After a long consolidation, the stock is losing some sort of momentum. So at current levels, one can go short for a target of 272 on the downside, and one should place a stop loss about 286. My BTST is in Godrej Consumer Products. The stock has given a breakout today, but looking at the intraday dip, one can buy at these levels. Stop loss would be around 970, and on the upside we could see 1025 in tomorrow's trading session. So definitely one BTST and one STBT.
Okay, one BTST and one STBT. That's the strategy coming from Rahul Randeria. Look at Bharti Infratel, another stock which has fallen by around 1% more, down 3% now. You also have SIS, which has lost another 1.5%. Some more stocks I can spot. Moil is drifting further. Fortis Healthcare has also seen some selling pressure. These are some of the stocks we are trying to highlight that have come under intense selling in last minutes of trade. Fortis Health, you can see now quoting at day's lows. There is on the upside also, if we have seen some amount of buying interest emerging at certain pockets. Let's look at those stocks. Gujarat Narmada Valley Fertilizers have been doing well today. So Gujarat Narmada has moved up. Jyoti Laboratories has found some takers in last minutes of trade. You also have slightly bigger stock like HDFC Standard Life that gained a bit, around 0.5% or so. Sundaram Finance has moved up. Whirlpool of India, now that is an interesting stock. It was trading flat till half an hour back. Whirlpool has moved up, in certain spurt that is seen at this counter. So these are some of the late movers, I would say, in today's trade. The movement is on both the directions, some gainers and some losers in last minute of trade. But net, if you look at the picture in this market, most of the index stocks are actually trading weak, and index is going to end the session close to the day's low, 10,048. Maybe we'll end below 10,050, because if you look at the last half an hour average, doesn't look like a higher closing is possible. On Nifty Bank also, a close below 24,900 is almost given. A decline of 250 points or so is what one could safely expect. Rahul, if you have had chance to look at some of the banking heavyweights like HDFC, SBI, ICICI, all these stocks came under pressure after the policy. They were trading in negative zone since morning, but especially after the policy announcement in last hour of trade, they've declined further. Any call on any of these stocks? Is there a trade really?
Looking at the current setup, it is most probably because of, as we discussed earlier, that because of the international cues, we are seeing the sell-off and after the policy. So rather than taking a call right now, I would wait for the price to get settled down, because already if you look at the banking stock, PSU banks as well as private sector banks are under pressure for quite some time, maybe a couple of days. So definitely the setup is getting oversold day by day. So I would wait for some price to get settled down and then take a call. Definitely at this point of time, it would be a very high risk, high reward kind of call to take go short at these levels. But I would wait for a price to get narrowed down and then take a call.
Well, RIL has supported the index quite a bit in today's trade. I would say that even now Reliance is trading higher by around 1.5% at 929. So in fact, it's close to day's high now. That is interesting. Even in last hour of trade, Reliance has seen some amount of buying coming in. Interestingly, there are not many heavyweights which have seen any recovery in last minute, but RIL is the one which is kind of leading and supporting the markets. Some of the high beta mid caps or the traders' favorite stocks, NCC is one which has traded strong today, even in last hour of trade is doing well, and also PC Jewelers. Sarvendra, have you had a look at both these charts? Any views?
No, absolutely. I think both are under regular coverage. In fact, as a disclaimer, both stocks are under regular coverage, and from time to time we have positions in both of them. For NCC, I think what is more important now that the move from around 80 to around 120 probably gets digested, and there's a small correction going on. So yes, I think at lower levels there's definitely a buy. The medium-term targets for NCC will be in the range of around 140, 150. So anybody wanting to trade from here should probably keep a positional kind of a view, and then it would make sense, because with the market choppiness, you might get stopped out in a trading position. So slightly a positional bias for NCC for a target of around 140, 150. If someone wants to have that, 3 to 6 months is the time duration. The stock looks good. Please definitely put a suitable stop loss. And PC Jewelers, I think clearly this one within that pack, now a fresh breakout out of long-term averages, wanting to hold that. Last week, 10 days has been holding above that average, and my sense is that once we break past 410 now, then the stock is probably headed for 440, 445. So again, the bias remains positive here.
Okay, let's look at how markets are closing. Finally, Nifty at 10,040 odd levels, down by around 77, 78 points. Nifty Bank down 270, 272 points, 24,848, 24,850 approximate levels. If you look at the index movers today, RIL was definitely a star performer, because even in weak market, Reliance Industries closing at day's high, almost at day's high, up around 1.5% or more than that, and also with significantly high volumes. Volumes at RIL were actually higher by around 83%. That's interesting if you look at the average volume. Tech Mahindra was yet another stock that supported the markets. On the negative side, we had Hindalco, Bosch, Bharti Infratel that really were putting pressure on the index. If you look at the broader market, if you could just look at the advanced decline ratio, it remained 50-50 through the day, but I guess towards the end, the gap widened, and finally, this was the worst equation of the day that we have seen at around 330. There was definitely some selling that re-emerged even at mid-cap and small-cap counters.
Yeah, and banks, I think, largely stayed down. On the Nifty 500, no big losers. I must tell you though that we didn't have stocks which are down about 8-9% or thereabouts. So a large concentration of selling on heavyweights in the large cap space. Radico Khaitan down about 5.5%. I think Pradeep marked a bunch of these. Hindustan Copper down about 4.5%. Praj Industries down about 4%, but nothing to the tune of 8-10%. It was an okay kind of a sell number that we had today. Just want to bring up, before we wrap up and take our final thoughts from our experts, just want to bring up what the world futures are up to. Remember, as we head towards the close, I think the Dow futures have about have a small downtick, and the European markets are trading flattish to marginally negative. So the world is not a very terribly happy place, not a terribly sad place either. Final thoughts really from our experts, and we need to make it quick. The mutual fund show about to start. Rahul, very quickly, what levels would you watch out for? Nifty or the Bank Nifty?
Yeah, Bank Nifty, as we discussed earlier, that 24,600 is a 60% retracement mark of the previous rally. So at these levels, as we discussed earlier, that after 7 days of sharp deep correction, one could go long with covering on the downside by buying a put of maybe 24,400, 24,500, and just hold on to the positions. In the Nifty, 10,000, which is a psychological mark, and again it is a 60% retracement mark of the rally, which started from 9,687. It went up to 10,490, and currently it is just nearing to those levels. So definitely at these levels into deep post-hold territory, I would recommend to buy Nifty futures with a buying of put on the downside. So one can cover the downside as a hedge towards the long positions.
Pradeep, trail stop losses if you have a short position existing. Would that be a prudent idea?
Definitely, it would be, because the way we have corrected, we probably went to the second target level on the downside, so bears won't be really too unhappy with the kind of moves they have got, and on the upside now it's going to be difficult for bulls to cross 10,100 mark or near about those levels maybe. So yeah. I think we are driven more by the global markets. This was just an event that short traders were waiting for. True. And I think the trend is going to continue. So far as the current trend is concerned, it's on the downside.
just keep in mind that there are two large events, one global in nature, and while we are looking at our own backyard to try and see what's happening, maybe the real monster or the real event is happening out there, and watch out for the 12th and the 13th. That could be an interesting one on the Fed side. And then of course we have those election verdicts coming in from a domestic perspective. Maybe the market won't be too disappointed with a tight race if the market's anyways correct another 200 points, because then we'll have about a 500-600 point correction before any kind of verdict comes out. That might actually not be a bad scenario. But anyways, lots more to talk about, and I'm sure me and Pradeep will be back tomorrow morning to take you through all of that. For now though, from me, Pradeep Pandya, and the team that put this show together, thanks so much for watching. But stay tuned, because the mutual fund show comes up on the other side, and we talk to Radhika Gupta and Amol Joshi about how should you protect your investments if indeed equities are looking uncertain. All about balanced funds coming up on the other side.